Want my latest market insights? My latest report, Trend Long AST Mobile Option Update plus 60,000%. Good enough is now available. Scan this QR code or click on the link in the description. Hey everyone, we're live. All right, welcome to Macro to Micro Options Power Hour. I'm Samantha LaDuc, founder of LaDucTrading.com, joined by Hans Albrecht, our options mentor for our LaDuc trading clients, and we exchange a lot of information, mostly in our Slack member workspace, but also in this weekly webinar that we do in a kind of Ask Us Anything format, from macro to individual stock selection, as well as options market, both for the market and underlying issues. We have been really front and center of being tactically long. I am still macro bearish for all kinds of good reasons, but for the most part, the market is not even pausing long enough for volatility to perk up a little bit, even though Armageddon hedges started coming in last Monday. And there has been some breadth decay, which I do identify for clients, and that started about 3 weeks ago. It doesn't mean you short all-time highs, but it means that it's stalling, and then it can turn into weakness, and it has started to turn into weakness, but there hasn't been strong selling underneath the surface. So what I then look for is any signs of currency volatility, rate volatility, or equity volatility. And like I said, we don't have any on the equity front of a note, but we definitely have some, intonations that they're hedging aggressively for potential problems. We had a new prime minister, as discussed with clients last week, in Japan, and she is much more fiscal expansionary than her four candidates that she was competing against, which were constraint. Long story short, I posted she's Abe 2.0, and that has resulted in the yen falling out of bed. For those who look at the proxy of FXY, basically 60 is a nice area of support for a potential bounce. Anyway, so the dollar yen keeps screaming, and it's really not bearish the US equity market unless yields were to travel with it, but they're not. Anyway, we did have a little other currency volatility. I warned clients Monday and again on Tuesday, get ready for a dollar bounce. And it's only the rate of change in this bounce that can actually serve as a headwind to equities. But for right now, it is mild, pushing from that 97, 98 into 99, 100. It's once we start to see how it behaves there. Big picture, we have not had any bond bounce of size, but the more the government employees are furloughed and potentially permanently fired, and IRS announcing they're cutting their workforce in half again, we will definitely have some unemployment that starts to trigger and recession risk pulled forward. And we could get a little bounce and support with this dollar bounce with whatever comes our way with rate volatility. But for right now, the market is still enjoying this AI wave. And I know that we've both been playing it in our own ways, from space and defense, government, US government as kind of venture capitalists. That's my theme. Yours is non-negotiable plays, because they're just going to get infusion of capital from the government or from each other. And then last but not least, we do have this attention on the AI ecosystem players, massive big cap players like the NVIDIA at 4.5 trillion market cap, and all of this correlated kind of round tripping with OpenAI and Microsoft and AMD and the whole universe. But a client of mine said early and often that this was going to turn into kind of like a Japanese karetsu, which is this very tight ecosystem of suppliers, and they would really kind of control the rails. And sure enough, he was right. Client George was prescient in that call that what we deem as financialization and round tripping would turn into, yes, an AI mania bubble, but also a new form of kind of keretsu. So anyway, that was it in a kind of a nutshell. The market is still pushing its way into higher, and earnings are a few weeks away. So we'll have to see how they did for Q3. But we have no data for unemployment or jobless claims or inflation. So we're kind of blind, and the market also, believe it or not, likes that. So Hans, any other insights on your take with the market shenanigans and then, of course, market structure?
I mean, look, it's again, it's the broken record. It's the gift that keeps on giving if you're long, which is yesterday I did mention I actually put on a little bit of a downside broken wing butterfly on some semiconductors. And I said, I'm going to add to that. It was just kind of a dip your toe in, which I like to do sometimes just to kind of get it on my radar. And when you have some skin in the game, you feel it and you care more as opposed to just kind of thinking about something. So, and I said, listen, if we rally back to a certain level, then I think I'm going to add to that. I'll see that as potential. If it fails, it did not. The SOX went bananas again to the SOXX. The SOX will close on its highs, which is the triple lever, which is fun to watch as well. That was not a bearish bounce. It's business as usual kind of bounce. So this is not yet any kind of real convincing tradable sell-off. And we can see that across the board. We see even MAG start coming back. We've seen some strength in Amazon, which has been crushed a little bit lately. Google, curiously, a little bit weak. It is relatively inexpensive. Meta's had its problems because, of course, of ChatGPT doing ads and things like that. So, but it'll shrug it off at some point. Microsoft's starting to do well as well again. And then Apple is like a savings account. It doesn't go down at all. It's quite amazing. So I've got huge positions in that as my favorite AI in your pocket play. And so, yeah, here we are. VIX back at 16. I don't know how low it can get when we start to get these melt up scenarios. We are seeing, and I explained this very clearly 5, 6 weeks ago. I said, listen, vols are too cheap. Options are too cheap. I said, you can win on long delta, you can win on Vega, you can win on skew, you can win on all these different ways. And that's exactly what's happened. Okay. It's 100% exactly what's happened because as this mania starts to play out, and I showed some clients a chart of Micron option pricing over the last, say, year. And what's fascinating about it, I'm going to show you guys because I think this is absolutely fascinating. Even when you sort of say, well, this is going to happen, it did happen a bit faster and a bit more strongly than I thought it would. But we see this very similar reaction in option volatility. And when I say volatility, I just mean option pricing. So I say vol is just the way you say, oh, what's the vol on Micron? Oh, this just means where are they pricing options? And so if you look at what the pricing looked like in April when the market was crashing,
Do you want to show us?
yeah. Let's
Okay.
take a quick look here. So when we look at something like this, it's really a master class. And look at this rally in Micron. I mean, I kind of thought, boy, this is topping out. We pulled back to 185. I sold most of my position above 192, 193, 195. And I said, boy, I really nailed it because options were really showing a little bit of exuberance. And I'm going to show you how that looks here. So if I look at 360-day volatility, so I'm looking at 1 year option pricing, we can see rank and percentile very, very high again. It's not exceptionally high, not as high as in April, but what we're going to look is at absolute values for option pricing. We can see that in the gold here. So we can see that in April, we got a crash up. Let's pick the right sort of delta. We're going to get rid of the pesky historical volatility, which means nothing at the 1 year mark to us. So look at this. So what looks similar here? Well, let's play a game. What part of the curve looks similar here? Well, it's this and it's this. It's option pricing zooming to massive levels and then collapsing, and then option pricing zooming to high levels again. And this is where we've been talking about. This is where I said, listen, this is stupid considering what's going on in the world. I said, we cannot, how do you value this market with AI inference and what's happening in this gigantic regime shift? And I put out a tweet. I said, anybody, if you've been listening to anybody who thinks AI is a bubble, I'm not talking about stocks. If they think AI is a bubble in a passing phase, please cancel their number, cross it off your list. Do not answer the phone.
Wait a minute. Paul Tudor Jones was just on Risk Reversal podcast saying exactly that.
No,
He's
he
been
said
through
we were
it.
going to.
He made
He
his
said we are going to
billions.
melt up. He said we are going to melt up massively and then collapse. That is a very different thing. We are talking
Everybody
about.
says that. Everybody wants to time it
Well,
perfectly
I
too.
know it. It adds no value. The Goldman CEO came out and he said, "Yeah, I think we're going to have a sell-off in the next 2 years." I was like, "Gee, now I know why I own Goldman Sachs." When you get insight like that from a guy who makes like $100 million, who says we might get a sell-off in the next 2 years, I know where my money's going. So anyway, yeah, those are really great calls. Wonderful guys. I know actually 3 big hedge fund managers saying, "Well, there's shades of 99, 98." Of course there are. It's a market of thousands of stocks. I can pick a whole bunch of stocks that shouldn't be worth anywhere near what they're worth. Nvidia trading cheaper than Walmart is not one of them. That is not a bubble. So the point is that AI inference and the way it's changing the world is absolutely nowhere near a bubble. Let's have a chat in 5 years when you don't even recognize the world anymore. But of course, we trade markets, we invest, we have to sort of play the runs up and down. Right now, it's just a run up. That's sort of the backdrop to all this. It doesn't doesn't mean that stocks can only go up. But if you are thinking this is some sort of passing fad, then I think you're kind of on the wrong side of things. So anyway, back to this, which is zoom up in option volatility. Guess what? When it happened? When markets sold off in April, everything crashed. So then we come down and then we zoom up again. What's the difference here? Well, we're not crashing down, we're crashing up. And that's exactly what I was talking about. I said we are going to potentially be in a 99, 2000 environment where we crash up. So we are seeing a reaction from markets to, what is happening here? We could potentially go bananas. We look at the ARKs, the ARKG, the ARKK, the ARKF, there's a whole bunch of ARKs out there, and they are all kind of in the more sort of fast money, fun money kind of realm, but not totally. There's Biotech, which I've been big on. We've been making money there. So there's areas where we kind of go, well, okay, AI is going to start doing some pretty amazing stuff. You can say it's exaggerated, and it will be at some point because we're human and we're going to over expect. But we can imagine that once you have computers sort of working on things, we may be solving diseases and problems. I mean, I certainly hope so. So we're starting to get excited about the possibilities out there. And I found this very fascinating that you had a very similar idea, reaction, which was crash down and then crash up. So this is why I started selling some of my positions, because I said, look, I have made money in the ways that I thought I would make money. Now, this is a bit more extreme from the Vega side. So I'm going to get out of here because now I have the risk that this perhaps starts to come down. And it did just for a day. And now it's sort of pointing back up again. But it's a matter of not being necessarily negative on Micron, which I don't think is expensive and I think continues to go to the moon based on the fundamentals. But it's a matter of, okay, now I need to start looking at different kinds of plays. I'm going to be looking at call spreads. I'm going to be looking at certain kinds of butterflies. I'm going to be looking at various ways to play what is a very different environment from this, because probably more than a third of the money I made in this position is from the explosion in option pricing. And so that's sort of how I'm starting to frame some of my, and this is not that rare. This is actually a little bit more extreme because this is kind of in that, okay, the US can't lose and it's going to be Intel, it's going to be Micron, and Micron happens to be in that memory space, which is people have underestimated for a while. So now it's sort of re-rating to maybe where it should be. And so I think that's kind of cool. So basically that's sort of the lay of the land in the vol space. I sent you over a file today, Samantha, and we can sort of see how the volatility is very low everywhere. Everything's come down, credit spreads. There's really not a whole lot of worry out there. And there's a certain level of liquidity that is very conducive. So it's kind of amazing that we can't get 2 days down in a row, but in a sense, it's just all gas, as you say. I mean, it's just all gas, but from not just from a support standpoint and a sort of stimulus standpoint, it's just you're cutting rates into good earnings, into easy financial conditions everywhere you look, into a positive wealth effect. I mean, love it or hate it, the wealth effect is really something they are relying on now. They want people to feel wealthy. And it's like having an ATM. You look at your phone and you're like, man, my stocks are up again. I'm going to go, I'm going to enjoy, I'm going to have some fun. It literally is a sort of self-fulfilling prophecy. Housing equity is very, very high. And then corporates, these massive companies are making so much money and they're buying back stock like we've never seen before. I mean, I can't remember what the number was, but I think we're pretty darn near records of stock buybacks. So that's kind of volatility suppression right there. Samantha, you and I always talk about the vol targeting and the systematic strategies. Well, guess what? Corporations themselves crush volatility in a sense. If you sort of isolate that one thing, is they're buying stock, and that is a support to markets, and that is also going to bring down option volatility. So, and then you just have this kind of dispersion. It's this leapfrog effect that's happening out there where it's mag one moment, then it's a bit of a broadening theme the next moment, but nothing really pulls back. One just stalls and the next one goes. And that's kind of how a roaring 20s plays out, as well as signs of a mania. And we can certainly think that some of that is a little bit of a mania, but probably based on some reality. Are we
So
pulling
are there
forward?
any sectors or stocks where you are bearish or not?
Well, I was sort of bearish on some of the rate plays short term, and so some of the rocket and some of those sorts of names. But I'm starting the way that I'm looking at things is, I think we've gone over this before, is I really do believe in a broadening. Now, I recognize that there's significant job problems. People are not hiring. There's plenty of data out there to show that this is a productivity expansion without hiring, it's a different picture. That's historically, you build factories, you build even technology, and you hire people. You don't have to as much anymore. So that is definitely a concern. But the productivity is going to kind of mask those problems in the economy. in the jobs market. But I truly do believe that this is something that can spread in the same way that the internet infrastructure spread to a couple decades of what all that stuff, e-commerce and smartphones and all that. This is now building the foundation for the inference, which is that big fancy word for, okay, what do we do with AI? How do we make it useful to us? And you're seeing an explosion of agentic AI, which is basically, we are going to see a level of innovation out there in technology that we can't even comprehend. It's not all going to be great, but when you can just push a button and create something and have AI kind of inform that product or service, or you're just going to get an explosion. And there's going to be a lot of misses, but there are going to be some hits too. So I do believe this spreads into the IWM, which is why I've liked it there, and a broadening into the sort of part of the economy that actually kind of has been forgotten a little bit because it's all about mag and big tech.
So in the broadening sense, let's talk about that and then take some questions and find out what you want to have us cover. Hans is obviously still very, very focused on the melt up, the AI ecosystem. There really isn't an area where he is bearish, and the VIX is obviously muted. And we have rate suppression, so therefore there isn't a volatility risk. So he's got a thesis now of broadening out, and it's very technically possible since small caps are sitting above the 2021 highs and the 52-week highs that were back in December of the Russell 2000 IWM 145. So it has to get and stay above there. The only thing I would mention on that is we have been in a very, very large shorts covering squeeze. Something I track very, very closely is called hedge fund factor rotation. And there was a Goldman post that said, this was just on Saturday.
Was that the most shorted basket?
Yes,
Samantha?
correct. So the unprofitable plays within the Russell basically are 43% of the components, and they are up a whopping 58%, whereas the profitable components within IWM are up 22% since the April low. And most of those, by the way, are in my sector of strength, which is precious metals, industrial metals, basically metals. So I kind of grabbed this while you were talking to kind of highlight that a current 1 month return of the most concentrated short stocks versus history, 21% return, ranks in the 98th percentile since 1995. Sharp squeezes, which right now 98th percentile, can typically continue in the near term, do not necessarily signal SPX downside or average, blah, 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 it goes on. But the point is the average forward return following a sharp 1 month rally of the most shorted stocks isn't so great. But the point is, I have found that they start here and then they trigger some volatility. We get some digestion, and then the market continues higher, and they pick the better fundamental players than right now, which is just, you see a lot of short covering, and short covering can actually trigger trend reversals. A few weeks ago, we were sizing up some battery plays left for dead junk. Oh my God, did they come up from the grave? And there's actually some fundamental push around that as well, even though China is far, far, far advanced in that effort of batteries. It's a very interesting space still as we're talking about uranium as hot fire flames. There's a question that was asked of you on CCJ and SMR. That's been a trend recommended long before the data center build out, long before ChatGPT. But the point is, this is now broadening to batteries. But was it really the fundamental play of rotating into batteries or oversold plays, or was it a short covering basket where we had a little bit of softness in the FANG stocks, and you could see that hedge funds were covering their shorts at the end of the month, and that continued, and they were selling a little bit of their VIP stocks, the Mag 7, just to lighten up a little bit. The other thing is, when you mentioned biotechs, now there are two components in the biotech space that I follow, and luckily Alexander, Dr. Kenton of Kenton's Corner of Biopharma in our Slack workspace, has identified this whole slogfest of the government shutdown and how its impact will affect big, large pharma manufacturers, right? The XLV. It's also not only come up from a very oversold condition after being pummeled post-Trump election and the RFK Jr. nominee appointment of head of Health and Human Services, but now they've kind of like ratcheted higher on some new drug pricing programs. So that's really helped. And the slogfest and government shutdown around healthcare, Medicare, Medicaid, and the rest. So biotech usually responds very, very well to one of two things. Either falling interest rates, which we really do not have, we're very, very sticky, and or this hedge fund factor rotation. So I know that there's this excitement that AI is going to make very, very, very successful the ISRGs of the world. By the way, that was a fabulous trade of ours back in 2023, 2024, but you notice that it's undergone some profit taking, etc. So some of these were early. Now that growth was pulled forward. Now they have to prove it. And the biotech right now rotation that is in full view, the ARC Genomics, ARKG, for example, and others are clearly benefiting still from this rotation into anything that could possibly run because we have this speculative excess still in play, this money bubble still in play, this FOMO still in play, and as I just showed you, the hedge fund factor rotation really clearly in play, where the latest squeeze definitely did not focus on quality. And it really was that dash for trash, micro crap universe that whenever I see it start to come up out of the grave like this, I have to literally say, okay, wait a minute. Okay, so plug just went up 3 times in 2 weeks. Is this fundamental or is this just hedge fund factor rotation? And usually it's hedge fund factor rotation and it goes back into its protracted downtrend. We may have something a little bit different now forming in specific sectors of the micro crap. But be very, very careful. Do your due diligence. Know what you own. It's not like First Solar. First Solar is a gorgeous trend long. It's done going down. It looks fabulous. I made a strong recommendation on that with Jeffrey's help because he's researched this battery space, the whole thing. But the point is, not everything is equal to a First Solar. So what other sectors are we still interested in? Of course, I'm looking for some volatility to come into gold, but I don't suggest shorting it. And I say that because of some of my intermarket analysis. Specifically, October tends to drive not just equity volatility, but for the Santa rally and year-end stuff, but also in precious metals. There's been zero sign of that. But I don't think let's just say it's dangerous to short the most powerful macro trend that we've had, where gold is outperforming both SPY and Bitcoin on a 3-year look back. So therefore, when you have folks coming out from just Dahlia, all of them are increasing their recommendation of portfolio holdings in gold, in this reserve asset that also, by the way, is used in the production of things. It's a real hard asset, which also has the benefit of inflation hedge, a big one. Also is a play on debasement, and retail around the world have been holders in Asia and India, Southeast Asia and India in particular, but it has been a central bank accumulation asset for settling trade outside of the dollar, so it's not going away. It's very hard to call a short on gold, silver, precious metals. Palladium, platinum are just starting. Copper, you can see what's happening with steel coming up now. Even FCX in a major disaster of a mine explosion, natural force du jour, it's still almost recovered its gap down just because there are no alternatives. Like now metals will be, in my humble opinion, the inflationary force moving forward. And inflation is very sticky. And I know folks are still looking for oil. I am absolutely not. But I think metals are the inflation off ramp right now. And all of a sudden it matters. They're in supply restraint. Demand is skyrocketing, not because of economic growth, but because they are absolutely a proxy for real things over paper. Paper's still getting chased, but the risk is to hedge in a hard currency that actually matters. And I don't think Bitcoin's going to take the mantle away from precious metals in the near future. I think gold is definitely having its say, and it's here to stay.
Yeah, and I agree. The thing is, again, as I've said, you kind of can't have it all. You can't have super low inflation and a massive boom, a big industrial kind of infrastructure boom, which I think is going to happen. I think we're going to get some really promising numbers over time. And I think those are the inputs. And that's part of the non-negotiables ideas that, look, the copper is very exceptionally important and rare earths are exceptionally important. So there are going to be forces out there that are going to contribute to some inflation, some supply chain problems. And I think that's very much why Trump and Sachs, et cetera, are trying to kind of shore up supply chains and think of where are we going to be in a year from now, where maybe I think we aren't as friendly. Right now, we're sort of in the fairly early stages. I know it's hard to believe, but there may come a point where it will be a little bit more contentious when it comes to, hey, we can't really give away more of our rare earths or whatever it is, or we're going to play hardball because we have a great deal of influence and power. But for sure, to your point, this early stage of what's happening is going to be a lift all boats. The tide is going to lift all boats, and a whole bunch of junk and crap is going to go too. And so that's why I'm kind of, and I really don't trade much junk. I have to say, I don't, part of it might be I don't get it. I can't get everything. I haven't been playing some of the really junkier ones. I'm not trading BBAI. They had horrible earnings. It goes down to $5 and then suddenly it's $8. You turn around, it's $8. It's a piece of crap and it's $8. It's gone up like 70%. So there's no question there's stuff going on out there. There's, as you say, the short covering, there's excitement all around, but you want to really understand where the trades are. You kind of rent something and then sometimes you can kind of own something a little bit longer term. And so for me, I almost always have some sort of a backdrop. So for example, right now, I have been excited about the whole data area. I call them my three horsemen of data, and that's the Palantir, Datadog, and Snowflake. And now Palantir is very, very expensive. I see Snowflake as being kind of the much more reasonable value name there. We're playing in a sandbox where nothing's really that reasonable, but you have to really kind of shift your brain into a different mode when we get into mania mode. As long as I see some of those breakout ratios that I've been talking about for months and months, I said, if we get up into here, we are in a mania. So if you're looking for deep value, you're not going to find it in some of these growthier names. Now, occasionally you can find it, and that was the basis behind my Micron. And that was just kind of, I think, relatively easy money. Easy for me to say now, but there's some things out there that aren't that expensive. But so Snowflake started to make, I think it closed at a new all-time high today. Palantir's kind of not too far from it. Datadog doing really, really well. There's Databricks as well, which is private. I've shifted a little bit from semiconductors. I won't lie to you. I've trimmed almost all of my Soxel. I've trimmed almost all of I just have some NVIDIA. I've gotten out of some of these things. I've trimmed a whole bunch of Micron actually. Just it seems stupid, but I did it because I had these calls that had exploded from the options volatility. So I don't want to not be involved. And today we had a huge rally. So I'm going to miss this if it keeps going because I really don't have very much. But I'm looking at areas where I think you can kind of trim. I think there's some validity to maybe they're going to overbuild a little bit in the short term. There may be some validity to that, but where I see some strength is potentially in the data crunchers. If you think about what inference means, it means we're going to be creating data on a bonkers sort of level, and we almost can't comprehend how much we're going to be creating. A lot of waste. But it's going to be where companies are really going to want to clamor to get on board and figure out what to do. And I've read quite a bit on Palantir, for example, where companies, they'll show you what they can do. And the people in the board, they said like everyone was speechless for 10 minutes. They couldn't even believe what is possible with some of the stuff, right? So these guys come in and they just, I know it's stupid expensive, but think of what they're accomplishing for companies that are like, well, okay, we got to figure out data and we got to figure out AI. And this company will come in and sort of take all your silos of data. If you're a company, you might have 50, 60 different silos of data, maybe more, and kind of start to make sense of that. And this is only possible now because of the infrastructure that's been built, because of the ability for inference to start to explode. And so it's just going to get better and better. Like, I don't know, somebody on Twitter, I said something, I'd waste too much time on there, but I said something and they're like, Hans, this is a bubble. Have you seen these? These things they're so inaccurate all the time. Yeah. Sometimes ChatGPT sucks. It's inaccurate, but you have to kind of think about the direction, not just where we are. If you just think of where we are, it's kind of like, I remember somebody telling me a story in the early 2000s once, and they said, streaming's never going to be a big thing. We're not going to stream movies. Are you kidding me? It takes me like 17 days to download a movie. That is the kind of thinking that prevents you from seeing over the horizon, which is, okay, eventually
But their time frames are different. I mean, everyone has to define.
Yeah.
I think whenever anyone asks me, what about? I always say, what's your time frame? So are you a zero DTE, or are you looking for the next 10 bagger over the next few years, which is why I recommended ASTS in February of this year. This is not something I expected to triple in a few months. It is well ahead of its skis in valuations. It's ridiculous, but it also has the anointed space sector, right? And satellites and anti-Musk And basically, who knew? It's got the ASTS space mob and a Rocket Lab. That was another one that was ancillary to ASTS. The point is, you can find really good ones and then they take on a whole life of their own, even whether they deserve it or not. It's way, 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 way extended relative to my idea of it's a sock drawer play. Keep it in there for a few years, it'll be 10x. Okay, it's 3x. Now what the heck do you do with it? Because that just happened in 6 months. So the point is you have to find out someone's time frame, their risk tolerance, their option experience so they can manage and navigate. So I don't know. I think people who are very critical of this AI future manifestation of growth are smart in their balanced views to be worried about the mania. And it will add what it adds later, but we're right now in the heat of the excitement and we go with it. But I don't think we should lie to ourselves that it's the be all end all of the trading ecosystem is just that, a trading ecosystem. Be careful for an investment time frame because it will have massive valleys and peaks, just like Nvidia. But the point is, I've got my own within that space too, and I did that write up a few weeks ago, and the sound hounds and they took off, and they have their own, like I said, aura of volatility. And that's a very fancy kind of technical term that says if you don't mind this volatility, then this market is for you, man. This is just awesome because there are tons and tons of AI memes and millionaires playing this and navigating this. But don't be complacent and don't be sucked into the religion that this is not going to be without much pain and suffering and a dark side. We just don't see it yet. So I'm very focused on the macro economic stuff, consumer lending, this incomes, slowdown, savings, all that boring stuff. At the same time, I can see these sector rotations and size them up for trades, but not necessarily get sucked into the hype. I'm very, very, very skeptical. It's just the farm girl in me. But anyway, commentary on gold, James, because you're taking off. I think I did this also in the member workspace. I posted a phenomenal podcast and some more deep thoughts. And again, there's just no reason on a macro time frame to be bearish. But yes, I do see October seasonal weakness. I just, like I said, I think I think this is a durable trend. Dollar, we're having a bounce. I think that's just a bounce. I think we roll back over. And that might also later, big picture, because it's a policy initiative. It is absolutely a design, not a bug for the dollar devaluation, debasement, whatever the D is. The point is we have every reason to continue to see this market advance against that backdrop. Like this inequities in precious metals and in metals, and it's inflationary. And there are all kinds of problems that will come down the road. In fact, Jeffrey did a fabulous write-up that I'm going to post for clients right after this webinar, in fact, where it has a few years that it could actually run before we start to hit a very big stagflationary recession of size, because it's very clear that the powers that be are also papering over a massive amount of delinquencies on the consumer side. So basically, AI is creating the high net worth individuals that are powering the high net worth economy, but not the masses. And this is something that the policy intervention helps also the fiscal spending. I mean, we're talking about massive infrastructure or venture capital investments into the capital markets here and abroad and defense spending. All of this helps to delay the real economy pain. But you can't just say AI will fix that. Bitcoin will fix that. That's BS. That's lying. That's just lying point blank, getting stuck into the religion. And that's not my thing. So anyway,
I agree with you. I think it's going to cause lots of problems, but I think we trade markets and we invest. And I think it's sadly, the market is just going to diverge more from reality. I know it can only do that so much, but that really is probably what's going to happen over time. Now, we're hoping that people kind of figure out through innovation and through all this wonderful productivity that we're seeing or hoping for, that we create new things. And employment doesn't take that, it's definitely already taking a hit. I mean, there's no question about it. We can already see it being a problem. But a great deal of consumerism is run by people who own assets and who are retired and who own homes and equity and all that stuff. It's sad to say, but there's going to be a forgotten layer of the population, perhaps. That's not a good thing. I'm not saying that's a good thing. But for folks looking to short things, I mean, I've been doing this so long. I can think of even when I used to do this, where it's like you see a melt up and it's just week after week and month after month, and you keep looking for these opportunities to short, and you're kind of missing out on, like, I wouldn't be getting short anything without out, if you're trying to short, like you always say, Samantha, if you're trying to short breakouts and new highs, I mean, it's insane. Like you're literally betting against a massive, massive market that is doing the opposite of what you're hoping. Now, once you start to, I mean, for me, in a market that's very, very strong, I will look for pullbacks to the 9 EMA. I will look for maybe even a breakthrough to the 20 EMA. But if a strong trend is still sitting above those trend lines, there's no reason for me. And then I will look at the relationships as well. I think those are very important. So I'll look at, okay, utilities versus SPY. How's that doing? I want that to inform some of what I do. But for me, I would much rather, and people learn this all the time in my programs, I say, listen, I don't short vol into a Mount Everest pointing direction in option pricing. It doesn't make any sense. I want to wait till things kind of come down. And so really the fact is that as we try to always pick the top, we are often wrong. And that goes the other way too. As you try to pick the bottom, well, guess today's lows or tomorrow's highs. And so wait for the trend to actually kind of show you that it's going to cooperate with you. I'd much rather jump on a horse that's sort of moving and running than to kind of wait for things to kind of bet against what's happening out there. So for anybody who's shorting things, I just don't get that. I don't
I've
understand.
got shorts. This is a fabulous backdrop for Abercrombie short. I've shown that with clients. It's been awesome. Home builders, when they hit XHB, hit 120. And in advance of it hitting 120, I said, that's it. It's as far as it's going to go. And it's already broken 110 on its way down. We already talked about the consumer lending shorts that were short-lived and they came right into price target and then bounced. At the same time, banks started to break down like Citibank. Client Jose just nailed that perfectly, and Goldman Sachs. And this is in advance of going into earnings. There's also T-Mobile. That was actually a recommended short. It was a pair trade with ASTS back in February. Long ASTS, short T-Mobile. And look at T-Mobile. It's breaking down very, very nicely. GoDaddy was another short. So there are inflated or they've pulled forward early and then they start to roll over. And then the real test is now that they've pulled back, like if you look at ICE right now, it's come right back down. It looks very, very different from the other brokerage and exchange stocks out there. And they just announced a $2 billion investment in Polymarket. That looks like a potential area where it's going to get defended now. So the point is there are pullbacks that get bought. There are breakouts that get stronger. For right now, it depends on time frame. So I always find shorts every single day. That's not the issue.
Yes,
but the predominance right now is clearly longs, sector rotation from oversold, hedge fund factor rotation to breakouts, to continuation plays on the US government as venture capitalist, to the precious metals, to industrial metals. It goes, I mean, there are tons of beautiful sectors and of course AI. A question, can you give more detail about your post about CCJ and SMR? And the reason, I don't know what post that was, but can you clarify for him? Because I don't know what that is referring to.
For me, I've been cycling out of CCJ and SMR. Not that I don't like those areas, but for me, I think of, well, where's my capital better spent? And so for me, I can see things that look better, and those things have had a wonderful run. It's the idea that I think some areas have gotten fully valued. I don't know if they're frothy, but CCJ's come a long way. And some of these, I've been trading SMR back and forth actually quite well lately, but it's a trade for me. Whereas there are times in the market where I'm just going to sit put. I'm going to sit there and just wait and wait, like a Hood or a lot of names that have done well. Figma right now is one that nobody talks about. So we were getting in at 51.
We sized that up in the room yesterday. It's a great little chase long. Yeah.
But it's real. It's a volatile stock and it's post IPO. So you're going to have some lockup issues and things like that. So it's going to be volatile, but this is a company that I think is going to do great. But that has to do with they've now, even before they were integrated into OpenAI, it was an unbelievable story, I think. Now it's even stronger. So that's a name where it got to 60 and I have some people saying, should I sell? And I said, no, I'm adding. And it goes up more. And I even added more in a couple of accounts. So you live and die by the sword. That is not an Apple or an Nvidia. So it's for an appropriate amount of capital. But I think there's interesting stories like that out there where there's this incredible, I'm starting to add to Upwork again, because I think there's going to be higher price points for people who are, you can barely find somebody on there to do work. And the price points just keep rising because everyone's clamoring to kind of figure out, well, okay, how do I do this? How can I put this? Figma's that design company that basically that's step number one. And they've got a massive, massive market share of it, even though it's software and that could change. So I'm always trying to think of, okay, what's this next thing that has durability to it? Where's the durability? Some of these little shit stocks, like they don't have durability. That's just a quick trade. Okay, that's just have some fun, get in. Okay, there's a short squeeze on something that makes no sense. That's fun. But I don't usually play those as much as I seem like I'm a kind of flipping around guy. I tell people, look, I'm not 22 anymore. I don't want to do that. I don't trade zero DT. I have no edge on that. What do you want me to do with zero DT options? I have no clue. I do have a clue that Snow is going to do well. Should it be worth $100 less? Well, I don't know. Maybe if this market re-rates at some point and they think, well, valuations are too high, that's different, right? Apple's done crap. They don't do anything good anymore. And the stock's up $100 for no reason. So there's a valuation in markets. And maybe we get to a point where the market just says, well, these stocks shouldn't be worth this much. So we can't predict that. So we're going to play with what we've got right now, which is trying to pick up on good stories where there's less disruption, right? Like I want to play the things that are disrupting that aren't being disrupted. And for me, that's the names that are like a Snow, like that they're going to be at the helm of disrupting. They are going to help companies to save money on all sorts of other stuff that they spend money on. And so that to me just makes a little bit more sense because and then a data storage and things like that. I've loved Nebius. I've been talking about that since $35. It's gotten a little bit up, hit 130. So I feel that whole sort of semi-foundation equipment area is a little bit up there now. And so there are definitely names where I'm thinking, okay, on a pullback, I can chip away at something like a Micron if it gets down far enough. But overall, I see the areas that have not had their day. Every dog has its day. They have the potential to to take part. So it's all about where's my money going to be better spent? That's kind of how I'm positioning now. Very data, not as much equipment, and broadening. I've been picking up IWM a little bit more. I have been for a few weeks. And I really believe there's the potential for a broadening of the goodness, of the happiness. And I hope so because the economy and a lot of people are gonna be relying on that.
So the answer, Jay, to your question on thesis for T-Mobile selling off, you won't like the answer, but back in February when I recommended the ASTS long, it was also a little bit cheeky that I said this. For those of you who are political, you're going to see this as the anti-Musk trade. And specifically, Musk was going into Doge, and some people were freaking out about it. I was actually really hoping there'd be some fiscal restructuring. But in any case, Starlink, his company through SpaceX, had partnered with T-Mobile. So that was a very much Musk-driven. In fact, they were doing Super Bowl ads and all that stuff. All right, so T-Mobile, if you were anti-Musk, you'd short it and you'd go long ASTS, which was basically ASTS satellite company was partnering with AT&T. So, and they have a much bigger kind of global moat. But the point is, it was my cheeky anti-Musk trade to go ASTS long. That was one of them. And T-Mobile short. The second thing was also immigration. So we had a Trump policy, which was to deport lots of illegal immigrants. And the T-Mobile business case is very much month to month, pay as you go. No big contracts, not like a Verizon Wireless. So no contracts. It is very much for transient, and it has a big base. Very affordable. But long story short, that worked. So Trump came in, did lots of deportations, and ASTS started taking off. And now they just signed a deal yesterday with Verizon, which is why it spiked $20. I mean, that's crazy valuation. This is for 2026 that they just pulled forward in 2 bloody days. So that was it. And then I can show you on a chart, T-Mobile has a gorgeous head and shoulders with a gap down on a weekly. So technically it has also confirmed. So that was it to answer your question on T-Mobile. Lewis, you can ask Hans directly about his programs, but we do have also on the website, LaDucTrading.com. There is options education, and there are his options mastery course that is superb. And then your question, Elias, considering present systematic risk, would you say a hedging position in VIX expiring in mid-January makes sense? Yeah, you definitely have to talk about any VIX trade because right now,
yeah.
Okay, so
I
what's
think
what's
so.
the deal?
As I've sort of been talking about, I don't think it gets too low. Now, I think people spend a little too much time on the VIX. Like I saw somebody on TV today going on and on about the VIX. Like, it's a great time to buy protection. Well, the VIX doesn't, as we've talked about in the past, look at 2022, we had a market that was down and a fund and the CBOE put protect index was down more than the market. So it's, for me, when I buy protection, it's not short term. Now, you may nail it. You may just, your timing may be fantastic. And maybe there are people who do that better than I do, that's for sure. But for me, I like to give myself a little bit of time. So I will go out a little bit. And I think so. I mean, I think dealers are probably really, really offside. If we do get some reason to get that VIX rolling, it does have the potential to get moving. Right now, it does not care. The correlation, the beta to the S&P has been, I haven't looked at it recently, but we looked at it a couple of weeks ago, Samantha, and it was like dead. It was not reacting, which in one sense makes sense because the market just almost doesn't downtick anymore. So why would the VIX care when the market doesn't downtick? It's a little bit of an unusual environment. We have exceptionally low realized volatility. That is something to be concerned about because it's unnatural. But yeah, I think you could put on some very nice looking call spreads in the VIX. I actually just today I put on some S&P spreads. So bonds is always bullish, but again, when I put some money on the sheets, and it has been an exceptional couple of months. Like it's a good market. I'm not a genius. I'm taking advantage of it, but I'm also going, okay, I put on some, what did I put on today? Some 640, some March of next year, 645, 65. So I'm not putting on something a little bit too short term because seasonally wise, I mean, I don't know, can we put much value on seasonality when we've completely ignored it over the last couple months? Well, probably because the last couple months tend to be kind of strong. Now, when everyone thinks something is the case, then that's probably when it doesn't, when it breaks down a little bit. So if everyone thinks we're going to get a big
Also
meltdown.
seasonally strong for dollar bounce right here, right now.
Yeah. So that, yeah. So
October
maybe,
October volatility is usual for equities, precious metals. Anyway, we'll see what happens. Your
that plays into
mid-January
our,
time frame.
yeah. So a 640, I put on a 640, March 640, 565 for $9.25. So you can pick up a, what is that, $75 put spread. And because of this, the relative steepness in the S&P, that it changes throughout the year, but it is always steep, meaning you're going to get quite a bit more from an implied volatility basis, which is just sort of the relative level of that option pricing that you're getting for the short put. So you buy the one that's a little bit cheaper, you sell the one, you might be buying one around a 17 or 18 implied vol, you might be selling one around a 25, 26. That's nice. That's going to help you. That prices nicely because you're getting a juicy, juicy premium for the one you're selling. So that's going to cut down on your cost. Now, as Samantha and I talk about sometimes, if you truly want crash protection, then you probably don't really want spreads. You want something with full convexity. So let me give you a quick example. I have a couple of people who own call spreads lately. And actually, I did as well. I had a call spread on USAR. I had all kinds of stuff on that. So that was one of my non-negotiables that worked out nicely. But I had a call spread. It was so interesting because as the thing started to take off and the rumors started to circulate that the government was going to get involved, that upside blew out. So I'm long one call and I'm short one that's now getting juiced up. And I'm not making money on this call spread. Sometimes skew and all that stuff that we have fun with, it can hurt you. Then the next day it jumped up further and they started to sell because people come in, they've bought upside, now they're going to monetize it, right? So sometimes you get that effect of if something goes high enough, people are starting to liquidate some of the positions that they bet on and that comes down. So what happened was I made money on the long delta and then the top one kind of got crushed. And so I started to make money on it. But skew can kind of mess with you. But it is a way that you can really cut down. If you sort of say, well, I think a reasonable sell-off would be 100 points on the SPY. Like it wouldn't be pleasant, but I think it's not going to get much worse than that. And a spread will allow you to really, really cut down and focus in on a sort of range that you're comfortable with. But if you want full crash protection, then you got to just go out. And what I would do is I would take your budget and buy something way, way out of the money. And you can afford more of them because of that. You can afford more contracts. So that's a good way to kind of. So,
And also
yeah.
the
So
crash protection came in. Remember on Monday, I highlighted that they came in $50 lower of size. We're talking 112,000 contracts for QQQ 555 kind of thing.
Yeah. My plan, and I remember having this chat with a bunch of mentoring students, and I said, listen, my plan is I think we're going to get a melt up. This was maybe 4 months ago. I said, I think we're going to go bananas. But what I'm going to do is I'm going to play it with cheap upside leaps, calls, things like that. And then I'm going to be adding downside protection to that because I don't know, like, something could break at some point. Because when you get incredible exuberance, you can also get a corresponding reaction to the other. When too many people are on one side of the boat, then the thing is now they're not. You look at some of these sentiment indicators. Although, boy, did you see the systematics? I mean, they are so. I couldn't believe that chart. They are absolutely massively into this market. So there are some indicators of a lot of people being in this market now. We know the hedge funds have come back again after getting it wrong. And on the other side, it's kind of one of the most disliked rallies. I don't want to use hated anymore, but it's maybe disliked or something.
I think distrusted is a better word. For
Distrusted,
really
exactly,
good reasons.
exactly.
The golden age of grift, Ponzi, financialization and Ponzi galore. Oh my God, there's so many things I could say about the falling dollar and policy intervention and. But yes, what I was going to show was, I can't find it, so it doesn't matter anymore. But we have it going on as it relates to right here, right now, the market drifts higher because of suppressed FX rate and equity volatility. But we do always have to keep an eye out for some macro event trigger. And as you know, I'm very focused on unemployment as the reason for the season. But that also is part and parcel for why I had the post a few weeks ago, recession into all-time highs, where that's where the government is just still using new tech to juice the economy, the stock market returns and high income earners and those who benefit from inflation. Inflation is definitely not going down. It's going up. We might get some deflation impulses from a growth rotation, but right now that isn't even front and center in my growth value ratio analysis. So long story short, I'm looking forward every single day and I'll let clients know. In the meantime and in between time, we're going to wish you a great rest of the trading week. We will see you next Wednesday after the close. We're getting closer to the FOMC and whether or not there will be any
Earnings,
Fed
we got
cuts.
some earnings as well starting soon, so that'll
And
be
earnings.
really
And CPI, if we get it, probably not. Government will be shut
Well,
down.
that's the thing. Like, is there a risk that some data suddenly comes out and sort of sideswipes the market? Maybe something unexpected.
I think they
There's always
keep papering over the consumer weakness and bank regulation. I just looked at one coming in. It's really papering over. So until we get an absolute risk off trigger that then can get these mechanical buyers to turn sellers, that's why they've got these Volmageddon or Armageddon hedges of size further down, much further down for some type of shock. Geopolitical unemployment, we don't know. The circularity of AI, it's now not just a few Twitter randos from 2 years ago saying, okay, this is financialization, it's legal, round tripping, but it's not really, but the government all supported this and off we go. So now we've got more attention on this narrative of AI and the circle jerk that is AI, but at the same time, no one's selling. Okay, so that's it.
To be fair, I wanted to close my part with I have raised about 35% cash. So yeah, okay, like I know, I don't want to confuse people, but just I mentioned how these options have gotten so expensive and so many of our positions are options. So but I have rotated a little bit into some other things. But yeah, like be nimble, people, get out, do what you got to do and play the environment. But I feel comfortable having raised a little bit of cash.
Okay, excellent. All right.
Okay.
Cheers. Bye.
Thanks, everyone. See you, Samantha. Bye-bye.
Subscribe to LaDuc Trading YouTube channel for more macro to micro options power hour and other content.